What if I told you that Veritone Stock could have one of the biggest AI opportunities in the small cap market, but at the same time, it could also be one of the riskiest AI stocks to own right now? VERI is trading around the sub $1 level, and after the latest earnings report, the market clearly showed that investors are worried. But here's where things get interesting. The biggest risk for Veritone may not actually be competition. It may be something much closer to home. So today, I want to break down the biggest risks that could crush Veritone stock. And at the end, I'll give you my own price prediction and tell you what I would personally be watching before getting bullish. And trust me, risk number one is the one that could completely change the Veritone story. Let's start with the most obvious problem. Number one, Veritone is still losing a serious amount of money. In the second quarter of 2026, Veritone generated about $24.3 million in revenue. That sounds decent at first, but the company still reported a GAAP net loss of roughly $22.2 million. And even on a non-GAAP basis, Veritone lost around $10 million. That tells me one thing. Revenue is moving, but profitability is still a major problem. Management says it wants to reach operating profitability as early as the first half of 2027. That sounds exciting, but here's the catch. The company has to execute almost perfectly to get there, and that brings us to risk number two, cash. According to the latest filings, Veritone had only about $12.4 million in cash while it was dealing with a significant working capital deficit. And there is another number investors should not ignore. Veritone has convertible notes coming due in November 2026. This is where the story gets much more serious. Because if the company cannot generate enough cash internally, it may need financing. And financing can mean dilution. In simple English, even if the business improves, shareholders could still get hurt if Veritone has to raise capital by issuing more shares. And that leads directly into risk number three, margins. This is something I think the market may be underestimating. Veritone's Q2 gross margin dropped significantly year over year. GAAP gross margin fell from 67.5% to 58.5%. That is not a tiny move. That's a meaningful compression, and Veritone itself pointed to a different mix of lower margin revenue as one of the reasons. So now we have a strange situation. The company wants to grow AI revenue, while also cutting costs, while also improving margins, and reaching profitability. That is a lot of things that need to go right at the same time. But now comes the twist. Because despite all these risks, I don't think the Veritone story is dead. Actually, there is one part of the business that could completely change the narrative, and that is Veritone Data Refinery, or VDR. And this is where things get really interesting. Veritone has been seeing strong growth in consumption-based revenue, and management is trying to turn VDR into a much larger commercial opportunity. If that business starts converting its pipeline into large recurring deployments, the market could stop looking at Veritone as just another struggling small AI company. It could start valuing it as an AI infrastructure and data opportunity. But there's a catch, and this is risk number four. VDR growth is not guaranteed. Management itself has highlighted the uncertainty around consumption-based revenue and the timing of government contracts. That means a big pipeline doesn't automatically equal big revenue. Investors need to see actual contracts, actual deployments, and most importantly, actual cash. Because this is where I think a lot of investors can make a mistake. They see AI, they see a growing pipeline, they see a stock trading below $1, and they immediately think this could be the next big winner. But the stock market doesn't reward potential forever. Eventually, the company has to prove that potential with numbers. And that's exactly what Veritone needs to do. Now let's move to risk number five, competition. Veritone isn't operating in an empty AI market. It is competing for enterprise AI and data-related spending while much larger. Companies have enormous resources, massive customer bases, and billions of dollars available for AI investment. And this creates a serious challenge because Veritone doesn't have the financial firepower of the biggest AI companies. So it needs something else. It needs technology that customers actually want, contracts that keep growing, and a business model that eventually produces consistent profits. If it can do that, the current valuation could look very different in the future. But if growth slows down, that's when the low share price could become a trap. And now we're getting to the part everyone has been waiting for. What do I actually think VERI could be worth? VERI recently traded around the 0.80 to 0.90 area. And in my opinion, this is no longer a stock where I would simply say, AI is growing, therefore VERI will go up. That's too easy. My bear case is pretty straightforward. If cash pressure gets worse, if dilution becomes necessary, If margins remain weak, and if VDR growth disappoints, VERI could potentially fall towards 0.50 or even lower. And honestly, that's the scenario that would scare me the most. Because when a company is already struggling with losses and cash requirements, another financing round can put serious pressure on existing shareholders. But here's where my base case becomes more interesting. If Veritone stabilizes its finances, continues cutting costs, improves margins, and VDR starts producing meaningful growth, I could see VERI recovering toward the $1.50 to $2 range. And then there is the bull case. If VDR becomes a genuine growth engine, the company gets closer to profitability, and investor sentiment turns around, I wouldn't completely rule out a move toward $3 or even higher over the longer term. But I want to be very clear. These are scenarios, not guarantees. Personally, I would not chase VERI simply because it is below $1. I would want to see three things first. Improving cash position, better margins, and real VDR revenue growth. If those three things start happening together, that's when I think the risk-reward becomes much more interesting. And here's my biggest takeaway. Veritone doesn't need to become the next Nvidia to make VERI interesting. It simply needs to prove that it can turn its AI opportunity into sustainable revenue and eventually sustainable profits. But if it fails to do that, the low share price won't save shareholders. It could actually be a warning sign. So now I want to hear from you. Do you think Veritone is a potential hidden AI winner at these prices? Or is VERI simply too risky because of its cash position, losses, and potential dilution? And where do you think VERI will be by the end of 2027? $1, $3, or much higher? Drop your prediction in the comments. And if you want more deep dives on small cap AI stocks before they become mainstream, hit that subscribe button. Because sometimes the biggest opportunities and the biggest disasters look almost identical at the beginning.